The International Monetary Fund says interest rates need to rise more in Australia to bring down inflation, which remains stubbornly high. Joining us live now, the independent analyst, Evan Lucas. Evan, interesting language from the IMF. How likely is it that it gets adopted? They're suggesting one. I think everyone agrees there's going to be one now at some point, but probably two more.
Yeah, they are. And so on that point, at the moment, looking at the final survey that came out from Bloomberg yesterday, of the 36 economists they surveyed, 34 of them agree that next Tuesday, is going to happen. Of those same 36, 20 of them have December now penciled in as well, which goes in line with what you said around the IMF. Now, the IMF had sort of a double-edged sword in that sort of report that you were alluding to there. The part was that Australia has done very well over the post-COVID era, that they are impressed by maintaining growth, have maintained an unemployment level that is at historic levels, and that overall we've absorbed the pressure inside inflation quite well. But their caveat, and this gets to your question around why they want rates to rise, if we want to continue to maintain that scenario, we need to get what they refer to as sticky inflation back under control. And the reason for it is that, as they all point out, including the RBA, how corrosive inflation is. If we were to leave inflation at the current level, which is about 5%, for another 3 to 5 years, $1 today is $1.32 in 5 years' time. And that means that the ability to continue to do what we've done will just not be met. We will not be able to keep up with the price inflation, to therefore keep up with purchasing power and the ability to maintain a living standard that we have. So that's the push-pull, and that's why they are so strong on the idea that we need to raise rates further to get inflation under control. The caveat and the final part to that story, Pete, 500,000 homes roll off their fixed-rate mortgage from the COVID era from this month all the way through to April next year. They will go from being on about 1.5% to 2% to as high as 6.2%, which is almost 3 times the monthly repayment that they're currently paying.
But, I mean, on that point, though, I mean, there had been expectations of a mortgage cliff from those who are on, but that never happened. So will this next batch happen?
It's more about the buffers that everybody has had have been unwound. So those that have come off, what you've seen, if you look, the report that came out of CBA at their earnings showed you that those pretty much under 55, who more likely than not have some form of loan, mortgage, personal, etc., they have now been completely diving into their COVID savings. That remaining 500,000 is about to do the same thing. So inflation's probably going to come down quite quickly. Yes, it might not cause the so-called cliff, but the pressure that is there, the change in behaviour is already there. And despite Monday showing retail sales was the best month of the year in September, habits have changed again. Things like cafes, restaurants and going out didn't grow at all. Travel didn't grow at all. What did grow was things for the home. People were actually going back out and buying hardware, were buying things around gardening, etc. That's what drove retail sales. And that's also what we're likely to now see, is that people are consolidating what they spend.
Okay. 30 seconds left, Evan. The Fed Reserve holds interest rates at 22-year highs.
They do, and the expectation of them actually going further is now dropping like a stone. So for December, went from 28% to 19% chance. For March next year, went from a 45% chance to 20%. So the expectation is that they're not only are they holding, they're done. That needs to be seen, but it's a big step forward for that idea.
Okay. Good to see you as always, Evan Lucas there. Appreciate it. We'll talk to you soon.